Thanks, Nirav. Good evening, all participants. Thanks to Varroc Engineering Management for giving us the opportunity to host the call. We have with us the senior management represented by Mr. Taran Jain, Chairman and Managing Director, Varroc Engineering, Mr. Arjun Jain, Whole-Time Director, Mr. Mahendra Kumar Karumanchi, CFO, and Mr. Bikash Dugar, Head Investor Relations. So I'd like to hand over the call to Mr. Taran Jain for his initial comments. Over to you, sir.
Yeah, I'm Taran Jain here. Good evening to everyone, and I thank ICICI Securities for hosting this call. To start with, the geopolitical situation in Europe and the Middle East has created uncertainty in the global business environment. The interest rates may come under pressure if inflation goes up further due to a spike in oil prices. Despite these uncertainties in the global markets, we see a resilient and a growing economy in India. The Indian economy has sustained its growth momentum in FY24 so far. Though urban demand has already picked up well, we are expecting the rural demand will also pick up with the current festive season. The automobile production in India during Q2 FY24 grew on a year-on-year basis for most of the segments. The passenger vehicles grew by 5.6%, three-wheelers registered a strong growth of 19.16%, and commercial vehicles grew by 8.8%. Only the two-wheeler segment has degrown by 1.5% as the early festive season helped Q2 during last year. Sequentially, that is quarter-on-quarter, we have seen growth in all the segments. The commercial vehicles have grown 7.9%, passenger vehicles have grown by 12.7%, three-wheelers by 33%, and two-wheelers saw a growth of 13.6% on a quarter-on-quarter basis, as Q1 is generally a sluggish quarter. In terms of our operations, in Q2 FY24, we continued our journey of improving operational and financial performance. Our revenues from operations grew by 3% on a year-on-year basis to rupees 18,868 million, despite a weak growth in the overseas markets due to the holiday season in Europe. The reported PBT for the quarter was rupees 739 million, which includes profit from a joint venture of rupees 80.6 million. Our balance sheet has strengthened in half one of financial year 24 as we pulled ahead some of the debt reduction initiatives to Q2 and reduced our net debt significantly by over rupees 2,714 billion and a net debt to equity ratio to below 1 time. Our debt servicing ability has also improved as net debt to EBITDA is now at 1.35 times compared to over 2.13 times at the start of the financial year. The annualized return on capital employed for the half 124 is around 23%. We continue to win the trust of the customers as they are awarding us more business. This is reflected in the new order win. In half one of financial year 24, a new lifetime order wins is rupees 36.02 billion.
There are more than 20 parties in the conference.
In Q2 of FY24, we have added 3 new customers for supplying components to the EV models. In the quarter, we also won business from 2 customers for supplying components related to the EV powertrain. These new orders will enable us to strengthen our presence in the EV component space. Our revenue from supplying to EV players in Q2 of FY24 was approximately 4.4% of our overall revenues. Our effort to increase our technical capability was further enhanced in half one of FY24 as we filed 9 patents in India and 1 overseas. As you might have noted from our submissions to stock exchanges, we've also signed agreements to procure power from renewable energy sources to the tune of over 36 megawatts DC annually for a consumption in the states of Maharashtra, Karnataka, and Tamil Nadu. We will continue to look for more such opportunities in the near future. We continue to enhance our engagement with OEMs and showcase our ability to deliver advanced technology solutions at affordable cost to them. We are also working on various other efforts like capacity utilization, prudent capital allocation, and cost reduction across the board to make our business more robust. With this, now I will ask MK, our Group CFO, who will walk you through the presentation, which is already uploaded on our website and submitted to the stock exchanges also.
Thank you, Saran. Good evening, everyone. This is Mahendra. So let me take you to the highlight slide in our presentation, which is slide number 2. As our chairman explained, the year-over-year revenue growth was about 2.9%. Maybe this was partly moderated by the early Diwali which we had in Q2 of last year. So the revenue closed at about 1,887 crores or 18,868 million. In terms of profitability, we are continuing the profitability journey. We are close to about 10% EBITDA or about 3.9% in terms of PBT. The absolute PBT was about 74 crores. Balance sheet has been significantly strengthened. You may recollect that in our earlier discussions, I mentioned that in H2 we'll be able to reduce debt significantly. But this time we actually could pull ahead most of that to Q2 itself, taking advantage of the higher revenue, so we could do more of factoring. And similarly, the higher realization or the realization from the sale of divestment last year, which we realized in the month of July, that also helped us. So with that, we could actually reduce debt by close to 300 crores compared to what it was 1 year ago. So with this, the net debt to equity comes down to below 1 at 0.94 to be precise. And net debt to EBITDA is at 1.35. Business wins, of course, our chairman touched upon already. In H1, if you see the total business won, it was like close to 36 billion. We also added 3 more new OEMs to the EV segment. And in terms of the EV revenue as percentage of total, it's about 4.4%, which should actually grow based on the new orders which we won recently. And like how we explained earlier, we are focusing more on cost reductions, and one of the areas is energy saving. Previously, we mentioned that we are actually tying up with a few firms to source more of renewable energy. So those things are in place now. There are still few more things to come, but we are still working on them. Going to the next slide about the industry. The two-wheeler industry grew by 1.5% year over year, and by about it actually grew by 13.6% on quarter over quarter. Passenger vehicle grew by 5.6% year over year, and sequentially by about 12.7%. So we still need to see what kind of impact all these geopolitical developments will have on the economy and the industry going forward. But we are hoping that the festival season should help us to some extent in Q3 also. Going to the next slide, which is about the consolidated financials for Q2. So like how we explained earlier, 3.9% was the PBT in Q2, which is up by 2.2% compared to same time last year. And you might have noticed that the interest cost actually went up compared to the previous quarter. That's partly because we prepaid some of the high-cost loans during Q2. That should actually help us in future. Plus the higher factoring discounting also is something which we actually consciously did it to repay the debt. So those are the main reasons. Going forward, we are hoping that this interest cost should come down in the coming quarters. The next slide, we give the overall H1 picture. Like how we explained earlier, we are always aiming for a faster PBT growth compared to revenue growth. So you see that H1 to H1, if you really see, the revenue grew by 6.4%, but EBITDA grew by 21%, and then PBT was almost like 3.5 times. So we are hoping to continue this kind of improvement journey going forward with heavy focus on growth as well as cost reductions. Then in the next slide, we gave the details of net debt. We are close to 1,000 crores now in terms of net debt as of 30th September. 1,006 crores to be precise. So the net debt to equity ended up at 0.94 and net debt to EBITDA at 1.37. The ROCE was 23%. And coming to the revenue breakdown, more or less similar to what we showed earlier. The overall 2 and 3 wheeler revenue comes to about 71% of the total, and about 15% of the revenue outside India compared to 85% within India. And the outside India revenue was also partly impacted because of the holiday season in Europe and other markets. In terms of the order win, about 36 billion was the lifetime business wins in H1. And interestingly, you may see that nearly 1/3 of that actually is in the EV space now, which is an encouraging trend for us. So that's it from our side. We are now happy to take questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. First question is from the line of Ashin from Equirus. Please go ahead.
Yeah, hi. Thanks for the opportunity. So, sir, my first question is regarding margins. So we have margins on a quarter-on-quarter basis has remained flat at 9.9%. So could you help us explain how do we plan to go to the 11-12% margins going forward? And what sort of a margin do we expect for the next 2 to 3 years?
Yeah, so thanks for your question. Mahendra here. First of all, we don't give this kind of guidance going forward, but I'll broadly tell the direction which we're planning to take. Definitely revenue growth plays a role, and the related operating leverage should actually help us to a large extent, because in most of our businesses, our capacity utilization is only around 60-65% level. So without incurring any extra costs or additional investment, we should be able to scale up our revenues in most of the areas. So the operating leverage should help us. On top of that, we are also working on various actions towards improving contribution margin. In the next couple of years, we have certain targets internally we are working on. Energy is one of those areas which I mentioned earlier in my presentation. But there are also certain other areas that we are working on. Plus, a continued focus on fixed cost control is another area. We just want to ensure that fixed cost doesn't grow in line with the revenue. Our internal target is to ensure that it grows at a much lower pace than the revenue growth. So that should also help us in terms of bigger improvement in the overall margins. And going forward, we'll be monitoring the businesses for performance based on PBT, not so much on EBITDA. So when it comes to PBT improvement, the interest cost reduction will also help us, because that is already close to 1,000 crores. Should come down further in the coming year or so. So that should enable us to reduce the interest burden. Plus the capex control also is going to help us in terms of reducing the overall depreciation burden in the coming quarters. So with all this, we are expecting that the PBT level, there should be some reasonable to good improvement in the coming quarters or coming years.
And sir, we said that we have added few new customers on the EV side. Could you please highlight what sort of business wins have been done, and which are the key product areas where we are seeing good progress?
So within the EV product lines that we have, our focus is really on the EV powertrain, which is the motor and the motor controller, and also on our connectivity devices. And the businesses we have won are around the powertrain.
Okay. And sir, about the customers which you added?
So we can't reveal the exact names of the customers, but one is a domestic startup who has not yet started production, but we expect to start soon with our powertrain. and the other is an export customer on a much larger capacity powertrain.
And then lastly, on the profitability on the EV product side. So, given the fact that now FAME 2 subsidy has been reduced, so do we see any impact of that on our profitability, given the fact that OEM might want to pass on that to the vendors?
I think our OEMs are very mature buyers of products, especially from us. so I mean, again, I can't comment on OEM strategy. They also have replacement benefits in place instead of a FAME 2, like a PLI, for example. But in our view, at least, our pricing with respect to EV product lines is sustainable, and we expect that trend will continue.
Okay, thank you, sir. I'll join back.
Thank you. Next question is from the line of Akash Gopani from Investec. Please go ahead.
Hello. Thank you for the opportunity. Taking forward that EV question, can you highlight what would be the timeline when we can see this revenues flow into our Concall operation, and any tentative timeline pertaining to when can we see this revenues reach peak in our EV revenues?
Okay, so I think the first thing to say is, in terms of reaching peak, I think it's much harder to comment, right? I think because it depends, there's a lot of variables around OEMs reaching their peak needs. From the standpoint of by when we could expect to start seeing revenues coming in, I would say within 12 months, right? We've always been fairly consistent in terms of saying that our products are ready, our platforms are ready, our manufacturing lines are ready, which means we should be able to ramp up very quickly, and I think that's why OEMs like us. So that's why within 12 months, we could expect to start seeing revenue.
Okay. And Arjun, would it be right to assume that the ASP for this product would be somewhere around 15,000?
Again, I cannot comment on specific segments, but yeah, I mean, it will be significant.
Okay, got it.
And the larger the powertrain, the higher the price point, of course.
Got it. Okay. Coming to the non-EV business side, over there also we have seen sharp increase in order book. So any significant order win or breakthrough in OEM, which the company has been able to do over here, or any increase in share of business with particular OEM we are seeing over here?
I mean, today we are present really across the entire two-wheeler segment, and we're present with multiple customers, even in the passenger car and the commercial vehicle segment, right? So, of course, we report, EV separately in terms of business wins for multiple different reasons, but I think the rest, I would say, is really just, par for course, right? We keep driving penetration, we keep driving improvement. Within that, if I had to call out certain technology products, even for an IC engine, we would have an integrated starter generator, for example. Right? So I think that would maybe be a highlight, but most of it is just normal sales growth and normal sales wins in the capacities that we have available already.
Okay, got it. And lastly, any comment on the lighting revenues decline QOQ, which we have seen? Any particular reason? Is it pertaining to European operations?
Yeah. So, like we said earlier, Europe has shut down for, in this quarter. So that would definitely be a primary driver. The other thing also is that, I would say with India, I think, we've been supplying at peak capacities for a lot of the OEMs. So, we'll have little bits here and there, etc. But I would not say that is a major contributor.
Okay. Thank you and all the best.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Vishal from Swan Investments. Please go ahead.
Thank you for taking my question, sir. And congratulations.
Vishal, sorry to interrupt you. Can you please speak through the handset?
Am I audible now?
Yes, thank you.
Sir, I have a question regarding the top line growth seems to be muted over last few quarters, if you see. So what are the measures you are taking to push the growth? Any guidance you can, share in terms of the top line growth which you can give? And, you were always you're focusing on the content per vehicle increase. So any light you can provide roadmap in that terms going forward?
So, of course, as we said before, we generally don't, provide, we don't provide guidance for the future. From a top line growth perspective, I think we are, we do expect, is generally the cycle for most customers is that SOPs generally take place, post-Diwali. So that we have, a fair amount of launches that will take place post-Diwali. But really, I think from a top-line growth perspective, in the spaces that we want to be in, we have a healthy order book, and revenues will come.
Okay. So perhaps this is why, if we see your vehicle-wise growth, which you have numbers which you have reported, two-wheeler business has grown by 4%, whereas overall volume in two-wheelers have grown by 15% on Q-on-Q basis. So the growth in the two and three-wheeler segment have remained muted. This is because maybe some outgoing platforms and we are awaiting for the new platforms to come in, and that may kick in the growth. Am I understanding right in that regards?
I don't think we've had any outgoing platforms per se, but of course, our largest customer has degrown to a certain extent, right, quarter over quarter, which definitely impacts us. But I think if we think about it again from the perspective of our content per vehicle and where we are seeing volumes grow in the market, we do have significant content per vehicle, right, which is something that will keep panning out, something that will, keep panning out over time. Further again, right, we said, like we stated, from an overall growth in revenue standpoint, we do have revenue that comes from Europe, both in two-wheeler as well as, from MS, for example, right, which is heavy forgings, which, yes, in this quarter will, there is a summer holiday, right, which impacts sales to a certain extent. But, yeah, to put it differently, there is no platform that have gone out per se which has impacted us.
Okay. Sir, any guidance you can give in terms of your capex spend? So for the half year, you have spent around 116 odd crores. What will be the full year capex for this financial year?
Yeah, Mahendra here. We may spend maybe another 100 or below 100 crores in the second half.
Okay. Thank you for taking my question. I'll fall in line. Thank you.
Thank you. Next question is from the line of Shubham Jain from NV Alpha Fund. Please go ahead.
Yeah, sir, my question is regarding the comments made by Mr. Kumar on the decreasing interest cost and increasing our PBT margins. Can you please tell me on indicatively, as of now we are paying 200 crore interest cost per annum. What should this interest cost start looking at going on incrementally over the next few quarters?
Yeah, so we don't want to give an exact number, but like what I explained earlier, we have close to 1,000 crores of debt left now in terms of net debt. Plus we typically do discounting of receivables to the extent of about 500 crores at any point in time. So based on this, we can broadly work out what should be the future cost. There could be some working capital swings in Q3. We are working on various initiatives, so there may be some temporary disturbance during Q3. But going forward, once we reach end of the year, I think it should stabilize and it should come down based on the levels which I indicated just now.
Sir, so at what level of net debt to EBITDA, today it's at approximately 1 time, at what level of net debt to EBITDA will you be comfortable to stop doing this factoring and incurring this excess interest cost?
Yeah, so we target to bring it about half X. That's what we are aiming for, but it may take some time. It may not happen immediately. It will take maybe a year or more to actually get to that level.
Okay. And what is the factoring cost interest? So 500 crores you said is factoring. So what is the cost on that approximately?
It's cheaper than the debt cost. It's anywhere between 8 to 8.3% per annum.
8 to 8.3% per annum. So this is off balance sheet. So you pay 10 to 12% on 1,000 crore and you pay 8% on 500 crore. Is that right?
No. The debt interest is around 9% now. So we also issued some interest. The interest cost on loans is about 9% now.
Okay.
We recently renegotiated some of the rates with the lenders based on the inflows which we got recently. So the average cost of
visible in the next quarter or so.
Yeah, it should be visible going forward. Like what I said in Q3, there are so many things which are moving around. You may not see a big swing or big reduction in Q3, but going forward in the medium to long term, you should be able to see this kind of reduction.
Okay. And second question from my side, sir, we see that your depreciation as a percentage to gross block, is slightly on the higher side as compared to other auto ancillary companies, which again suppresses the PBT margins. Any comment on that? Have you studied this as compared to other auto ancillary companies?
Yeah, see, it depends upon the kind of the mix of assets we have also. If we are talking about this particular quarter, we also took some kind of accelerated depreciation on some of the overseas assets just to keep the books neat and clean. So that impact may be there maybe until end of this year. And thereafter, I think once we actually control the capex spending in relation to the depreciation that we are incurring, slowly I think the depreciation burden should come down in the coming quarters and years.
Okay. Awesome. Thank you so much, sir, and all the very best.
Thank you.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Darshil from Crown Capital. Please go ahead.
Good evening, sir. Thank you so much for taking my question. So some of my questions have been answered. So just one broad-based question. So in terms of macro environment, what kind of feelings are we getting? Are we seeing that there is now going to be accelerated growth, or how do we see the environment as? And also in terms of our seasonality, so would it be fair to say due to Diwali, our H2 will be higher in terms than H1? Will that be a fair assumption, sir?
See, I think for us, we definitely feel that a half two, revenues will be more than the half one. Largely, I think, what we see that the Indian market, we still see a growth in the Indian market compared to the markets, globally, the other markets globally, where, the sales growth is quite subdued even now. And today, I think we are also hoping that, in a two-wheeler entry level also see some traction, in this season. So overall, I think we still remain bullish, on the growth here. And I think there's also the elections which is coming up, and we do see that consumption should be there. Consumption should go up also because of the forthcoming elections. Yes, there could be maybe some impact depending on this new war which has started on the oil prices, which could be inflationary in nature for India also. But I think overall, we remain optimistic and bullish, where the Indian market is concerned, which gives us today more than 80% of our revenues. So we do see a better second half compared to, the half one, from the point of view of our revenues growth.
Okay. Thank you so much, sir. So would it be fair to say it would be around 55-45 split in terms of H1, H2, H1, or it could be even higher in terms of pure seasonality?
I can just say it will be better. We don't know, but it will definitely be better.
Okay, sir. And so just one question in terms of, we cannot give guidance, but in terms of qualitatively, do we see that, are we, in terms of our revenue, are we stuck in a band of revenue and that will get accelerated as the market improves, or any statement, maybe not an exact guidance per se, but then do we see that, okay, we'll be able to cross the 1,800 to 2,000 crores revenue that is possible over the next year in the quarters coming by? Again, not a firm guidance, but maybe like, are we stuck in a range which is finally now we'll be able to open up and, come swinging? Will that be a fair way to look at it?
I would say, in fact, explicitly not, right? I think in many ways, right? I mean, if you think about the last few years, our focus has always been two-wheeler, three-wheeler. And it has not been an industry that has been growing, but we have still been able to drive significant growth as a result of very content-focused strategy, right? And I think that is something that continues to play out, right? So, as, EV increases in sales and volumes, and especially as our customers ramp up, as, stories around premiumization, urbanization, etc. also continue to pan out, I think we will only see growth. We will only, I think we're one of the first to really benefit from, the growth in revenue that takes place. So, but simply, I don't think we're stuck in a band. In fact, I think we are in a very good place where right? I mean, we're in a very good place, right? Where, if we compare half to half, H1 of last year and H1 of this year, the industry has degrown, the two-wheeler industry. But as Varroc, we've still grown by 6.5%.
Oh, correct. I think that, and so sir, just like, in terms of our growth, we don't see any risk or challenge, right? Except for maybe some war-like situation. Other than that, we don't really see any kind of risk, right?
No.
Oh, perfect, sir. Thank you so much, sir. All the best, sir.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Sachin Kasera from Swan Investments. Please go ahead.
Yeah, hi. Congrats on a good set of numbers. Just one question. The strong order wins that we have reported, so when should we start to see the benefit of that? More of H2 of the current financial year, or it will be more of a FY25 phenomenon?
This will be FY25.
More from the second half.
And it will be the second half.
Second half of FY25?
FY25.
Okay, so 12 months from now. That's when we start to see the real benefit of this strong order wins that we had recently.
Yeah, which we have just reported.
Okay, got it. Thanks.
Thank you. Next question is from the line of Pratik Poddar from Nippon India Asset Management. Please go ahead.
Yes, sir, a couple of questions. One is, maybe you could just touch upon when you see QOQ growth, as reported in your presentation also, across vehicle classes, it's quite strong, right? While YOY you have outperformed, on a QOQ basis, the revenue growth looks quite muted relative to the automotive production growth of India on the two-wheeler side, be it three-wheeler, PVCBs. And in fact, even the largest customer on a QOQ basis has grown. So I'm not able to reconcile as to why have these grown at 4% this quarter.
Yeah, so the largest customer has only grown by 2.7% Q1Q, and
correct,
grown by 8%. So, yeah, the industry, two-wheeler industry has grown by 13.6%, but like the largest customer, two-wheeler volume, their production number has only grown by 2.6%. So, as earlier stated by Tarun sir and MK Najum, that it's better to look at H1. And H1 we have grown by 6.5%, whereas the industry has only, two-wheeler industry has degrown by 0.2%. And there are new businesses whose SOP are going to start in the second half of this financial year. And as stated earlier, we remain confident that we'll do better than the industry growth.
Okay. The other is, when I look at your employee cost, very sharp accretion. In fact, it is something which has detracted your operating leverage on a YOY basis as well as on a QOQ basis. Just curious, why has that happened?
Yeah, Pratik. So a couple of things happened. One, we had some one-time good news in Q1. That's one of the reasons. The second reason is we also we are trying to change the composition of the workforce. We recruited some GETs and also some workforce at the entry level. which should actually give us benefit going forward in the long run. So that's another reason.
Yeah, but we remain conscious going forward, on all fixed costs.
No, so just to double click on this changing or pyramidization which you are doing, is it in anticipation of the additional orders which are yet to be executed and then we'll see the operating leverage? Is that the way I should think about it? So we are building capacity for future growth, but the capacity is built at a lower cost because you have hired entry-level graduates, etc.
Yeah, that is one reason. Secondly, we are also reskilling considering the growth prospects we have.
Okay, got it. I think one of the participants did ask, and you did say that by H2 FY25 we'll start seeing the new order book being executed. Over what time frame is this? In the sense, when you have won these new orders, in what time frame would you execute? Like, is it 3 years or 18 months, 2 years?
So again, Pratik, every customer and every program will generally have different development timeline, right? Passenger car development timeline is generally longer than a two-wheeler development timeline. Within passenger car, within two-wheeler, within commercial vehicle, different customers have different philosophies, right? So I think it's hard to put an exact number on it without actually explicitly delivering a revenue guidance. But I think, like we said, right, I think FY25 is when we expect a lot of this will go into manufacturing.
Sure. And the new orders which you have won, these are not replacement orders. These are over and above your base business, which you really do, right? So these are essentially filling up of capacities, which will drive operating leverage. Is that a fair understanding?
Yeah, absolutely. We don't report any replacement numbers at all. These are only new order wins.
Okay, fantastic. Last question. When you look at your largest customers, they've been quite vocal, at least in this conference call, about new product launches on the EV side, be it two-wheelers as well as scaling up their three-wheeler EVs. Is it fair to say that their scale-up, the content per vehicle in the EV, for them would be far higher than our base business, and that would drive operating leverage or that would drive revenue growth for us once their three-wheeler and two-wheeler EV business starts becoming more popular or starts gaining traction?
Yep, I think that is definitely fair to say.
And would you have 100% share of business over there with them?
No, I think platform by platform, model by model, it will vary. But, I mean, as you can
imagine, the predominant customer supplier, that's a fair answer.
It will always be significant.
It's fantastic.
Some products we could be a single source, but in some products there would be a sharing of business.
Got it, sir. Got it. And sir, correct me on the interest cost, a bit puzzling, right? You called out debt interest cost, you called out factoring cost. When I do the math and when I annualize your interest cost, it doesn't add up. How is that? Because look, you have 200 crores of interest cost. You said 1,000 crores of net debt at 9% interest, that's 90 crores. 500 crores of factoring cost at, again, 8.3, that's 40. So 90 plus 40 should be, whatever, 130 versus 200. Can you help me understand where is the 70 crores additional coming from?
Yeah, so there are also things like the lease interest, which is part of that. Plus there are bank charges. Plus there are things like prepayment cost, which we paid this time to get rid of some of the high cost debt.
And more
so if you annualize all this, it may actually work out to be that number, but going forward, some of these may not repeat.
What's the lease cost last? Maybe you can just call out that.
This is the lease, the interest component of the leases that we have.
Yeah, I understand that. What's the lease cost, like, per quarter?
I don't want to give the exact number, but you can broadly work out the difference. And second thing you need to keep in mind is this is like net debt versus gross debt, right? We also have about 200 to 250 crores of cash, which will scale down going forward. So you need to apply this on the gross debt also.
Understood. And what is this foreign exchange gain pertaining to?
Yeah, so it has both operating and non-operating parts of it. Operating is simply the restatement of these export receivables and all. Non-operating is relating to these loans and advances which we gave to our overseas subsidiaries and the businesses which we have there.
Can you call out the non-operating one, please, if it's possible, sir?
Broadly, you can say 50-50.
Okay, fantastic. Thanks and best wishes for the future, sir. Thank you.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Miyush Gandhi from Connexon Capital. Please go ahead.
Hi. Thanks for taking my question. So would it be possible to quantify the impact of European shutdown in this quarter? I mean, in terms of revenue, how much would we have missed?
Right.
Yeah, it's difficult to, we don't want to reveal that kind of breakup between overseas and India, but you can broadly say that for nearly more than a month, most of those businesses were closed for holidays.
Okay.
So that's
and would it be fair to assume, given the shutdown, the margins or probably EBITDA would be far lower, for this quarter again versus the previous quarter?
Yeah, obviously, because that revenue was not there, but cost would continue.
Okay.
They have continued.
Okay.
So, yeah.
So next quarter, maybe once the business comes back to normal, and there is some tailwind from that part of the business that can come through.
Correct.
And would it be possible to quantify the impact of, falling raw material prices on our top line? We've seen in the whole of 1 year, both metal part of the business and the plastics part of the business would have seen some deflation in the products, so that would have been passed on, right? So, just trying to understand, what is the underlying growth versus the deflation that hits our top line.
We can broadly say maybe it's close to 1.5% to 2%.
Okay.
So
it's not very large. It's not that large as such.
Right.
Okay. Fair enough, sir. And in this quarter, particularly because of this shift in festive season, that would also have had some impact on our top line growth, right?
Correct.
Any number that you would like to put it?
How do we estimate this? It's difficult to put a number to it.
No, the whole idea of asking these questions is to understand the underlying, top line growth, because we've been in this 1800, 1850, 1900 range for last 3-4 quarters, and we are actually hoping given this is the biggest quarter for us, this quarter would have been a little better on the top line front. So that's why I'm trying to understand where is the miss coming from. That was the underlying thought process, nothing else.
No, I understand. Yeah, but I understand your question, respect that also. But difficult to quantify it is what we're saying.
No, fair enough.
So look at annualized number. You should look at how much we have done in last 4 quarters and compare that to the previous 4 quarters number. If you annualize the numbers, then you will see that we have significantly grown.
And I would also say, I think if you compare H1 of this year to H1 of last year, we have grown. To be honest, I think as a result of semiconductor challenges that took place through 2022 or basically FY23, some of the revenue last year was a little bit maybe lopsided. But if you look at the half overall, the only real difference is the impact of the festive season. But we've still been able to drive a level of growth.
Fair enough. Sir, I may be completely wrong on this, and pardon me if I'm wrong, but if I recollect properly, our domestic lighting business, we were supposed to start a plant, and we were supposed to, in-house, in-source the entire LED light production. Is that already happened, or I'm reading something wrong?
Yeah, no, so we had already in-sourced. So we had not got any outsourced lighting production even last year. We are starting a new plant. In fact, it is partially started already, and I think that ramp up into from the old plant into the new plant will continue. But it is not an in-sourcing activity that is taking place. It is a location move that is taking place because, unfortunately, in the old plant we ran out of space.
And how much more capacity would the new plant have? Because you also mentioned in one of the answers that we are running out of capacity on the lighting side of the business.
So I would say space more than capacity, but yeah, we have the ability to add 40% more volume.
Okay. And just one last question. Any update you would like to share on what is happening in the China business? We were in an arbitration procedure with them.
Yeah, so both the approaches are continuing. The arbitration proceedings are continuing. On the other hand, the discussions with the partner on split are also progressing well. It may take maybe a little more time to actually conclude. So in any case, we are assuming that this should actually come to an end before end of this year.
Okay. Thanks. That's it from my side. Thanks.
Financial year.
Thank you. A request to all the participants, please restrict to 2 questions per participant. Next question is from the line of Vignesh Iyer from Sequent Investments. Please go ahead.
Congratulations, sir, and thank you for the opportunity. I just wanted to know, after the prepayment of this debt, what would be our now cost of debt as of after this prepayment is done?
Yeah, that's what I was answering in the earlier part of this discussion. You can roughly say 9% is the average cost of debt right now across maturity. Plus factoring is anywhere like 8 to 8.3% is what we are incurring.
Okay. But can we, as a part of the Ind AS statement, I understand that you have to show interest cost, but as part of the notes, can we have that bifurcation shown for better clarity as to what is your regular part of the interest and what is prepayment or bank charges, if any, that is getting debited under interest?
This is a one-time thing. It's not that every quarter we are going to have, and there is no requirement of Ind AS that we have to give this separately as a disclosure. But this is a one-time thing which should not happen going forward.
Okay. Because there is some discounting charges as well, right? That is a recurring nature of the business.
That will continue because that is the cheapest source of financing for us.
Right.
So that is the last one to be taken out.
Absolutely. That's all from my side. Sir, thank you. And all the best.
Thank you.
Thank you. Next question is from the line of Abhishek from Dolat Capital. Please go ahead.
Thanks for the opportunity. Sir, we have seen a strong growth in the polymer business in this quarter. So have you won any new business in this segment, and how is the outlook ahead?
So, polymer in general, right, across whether it is molded plastics, painting, seats, air filters, I think we have one new business which goes into production. We continue to win business as well also. So again, their growth is driven by a combination of, let's say, business wins that have been executed from past year. In some places, we also have, let's say, higher content, especially on topics like painting. And also in some places, maybe a level of natural growth from the OEMs.
Okay. And sir, how much difference in the cost of discounting of data versus loan cost, and how much benefit we get, and what is the normal payment terms you give to the customer usually?
Yeah, I think I answered this earlier in the call. The debt is at around 9%, and the factoring is somewhere between 8 to 8.3.
And how much normal payment terms to the customers? How much normal payment terms you give to the customer?
Payment terms, of course, vary from customer to customer. A large part of the customers is in the range of about 30 to 45 days. And then there are also certain customers in the range of 60 days and all. We are trying to rationalize that, but yeah, you can say average maybe around 45 days.
Okay, sir. Thanks.
Thank you. A reminder to all the participants, you may press star and 1 to ask the question. Next question is from the line of Rohan Prasad from Renaissance Investment Managers. Please go ahead.
Hi, sir. So this is again on your growth. So if I look at your largest customer...
Rohan, sorry, but your voice is not coming clear.
Hello, am I audible now?
Slightly.
Is it better?
Yes.
Yeah. So my question is on growth. So if I look at your largest customer, H1 to H1 revenue growth is something like 17%. So isn't it better to look at revenue to revenue growth versus volume growth? And considering that our growth is just about 6%, so could you explain this?
Sorry, I'm not clear what exactly is the question. Are we saying that we have grown more with our...
So I think your largest customer, Bajaj, has grown, H1 revenue has grown at 17%. I'm not talking about volumes, I'm talking about revenue. And we've grown at about 6%. Even Hero has grown at 4.5%. So in that context, our revenue growth appears to be on the lower side, H1 to H1 I'm comparing. Or maybe that's not the right way to look at it.
So honestly, it is hard for us to comment on customer
pricing and their revenues.
Yeah, it's hard for us to comment on customer like value or revenue growth. I think, of course, the pricing strategies, how I think that is best to speak with them. I think from a supplier perspective, I think looking at the volume and comparing their volume growth with what is our revenue growth, I think makes a lot more sense.
Okay. And can you actually repeat what is the capex you're planning for this year and next year?
Capex.
Yeah.
Capex, we may spend about another 100 crores or so in H2.
And how much have we done in H1?
It's close to about 110 crores or 113 crores.
And should we expect a similar number for next 1-2 years?
Yeah, it should be around 200 crores or thereabouts.
And just trying to work out your cash flow, so there should be any meaningful change in the working capital cycle that we have as of now?
Should not be. It should only get better is what we are trying. In between, there could be some ups and downs, but going forward as a trend, it should not get worse than what it is right now.
Okay, great. So basically, net next 2-3 years should be good on free cash flow generation for us.
Yes.
Oh, great.
Again, not a guidance, but yeah, that's what we're aiming for.
Yeah. So basically, all I'm trying to understand is that with about 1,000 crore debt, we should be max 2 years. We should be net cash.
Yes, ideally, yeah.
It should be maybe even early perhaps, but anyways. Thank you, sir. All the best.
Thank you.
Thank you. As there are no further questions, I will now hand the conference over to the management for closing comments.
So, thank you all for joining the call, and I would again like to reiterate that we will continue to drive profitable growth, be prudent on our capital allocation, and focus more on free cash flow growth and also on the cost reductions. Thank you once again.
Thank you very much.